Hello, friends. Welcome to this edition of IPO Review. I'm Piyush Jain, and you're watching it exclusively on ICICIdirect. Today, we are bringing to you a specialty chemical company, a company which is an example of Make in India, a company which has, over the last few years, created almost a portfolio of 25 products, a good healthy margin, 20-25% EBITDA margins, has been registering some strong returns on equity, and also a couple of products are actually making into the list of either top in the world or top in the India. We'll try and understand what is really working for this company, and the name of the company is Aether Industries Limited. Now, let me welcome the management, Dr. Aman Desai, Director, Aether Industries Limited, and Mr. Faiz Nagaria, the Chief Financial Officer of Aether Industries Limited. Gentlemen, welcome to the show. Now, first of all,
Piyush. A pleasure to be here.
Now, Dr. Aman, let me come to you and let's first decode the business model of the company. Now, specialty chemicals is a business which is normally associated with competitive advantage, with particular technical know-how, technical processes being placed, which is giving company a sort of distinctive positioning in the market. So help us understand what is really working for the company. And one line I would like to say, your returns are telling that you really carved out a niche for yourself. So help our viewers understand that.
Yeah, thanks, Piyush. A pleasure to be here. We are a differentiated manufacturer of specialty chemicals, advanced intermediates, built upon a fundamental base of competencies of chemistries and technologies. And so the company was founded with the vision of establishing niche, differentiated competencies in chemistries and technologies, and then the products out of these competencies are specialty chemicals across the industry spectrum and use. Pharmaceuticals, agrochemicals, material sciences, coatings, additives, oil and gas even. And our revenues are derived from three different business models, which have been created successfully in just 5 years of manufacturing, which is contract large-scale manufacturing, where we select our own products and launch them mostly for the first time in India, and then contract research and contract manufacturing services, where we are participating in the pipeline and launch molecules of various innovator companies across the industry spectrum globally. And so these are a very high level overview of the company, and happy to answer more questions.
Now, I was looking into the products, couple of products here. Now, for example, we are looking into 4-MEP again, commands very large market share. You have HEEP again, almost 34% market share. Then you have NODG, 47% market share. So before we go into all the categories, let's go into the pharma categories here and help us understand how actually you have really built sort of these large market shares into these products.
Yeah, so it's a great question. And so the large scale manufacturing business model, which is where these products belong, products that we have identified many years ago. We are an 8-year-old company in manufacturing only for 5 years. And so by many years ago, I mean 5 to 8 years, we have identified these products which were there previously imported into India completely before we started making them. We are the only ones in India that make these products today. These products were identified after a screening of the import data and a criteria that of the good fit for our chemistry and technology competencies. And then we have spent years in developing these products. And these products are multi-step reaction sequences involving an intricate marriage of chemistry, technology, engineering, automation, and systems. And then after years of R&D, when we establish capacity to manufacture these products, we enter with a scale and volume which is designed to help us achieve a market-leading position globally in these products. And so that also creates entry barriers for others to enter into these products again. Until today, we remain the only ones in India making these products, and these are some of our most powerful products.
Absolutely. So, Dr. Mann, I also wanted to ask one question. A couple of these products actually are direct competing with the Chinese manufacturers. Now, as we know in the chemical industry, one fact is that Chinese manufacturers are very competitive on cost. Now, if you're able to take market share and also again sort of grow your volumes, it also tells about your cost competitiveness. Now, help us understand, over the last 2 years, definitely a lot of market share, a lot of volume has been switching away from China. But help us understand from the perspective of margins, how you're positioned and where we are right now in terms of the utilization ratio of a blended utilization of the capacities.
No, great questions, Piyush. So at Aether, these products have been selected with a design of being competitive. And so these are generic advanced intermediates. And so we are the only ones in India making these, but before us, the Chinese manufacturers have been making this and exporting into India, and we have been importing from China. And so one of the prerequisites of establishing these products was the fact that we would be competitive with China at the same pricing. That is the design from day one. And then we have established numerous innovations along the entire process of all these molecules. And these are long processes which have enabled us to be cost competitive. And to the extent where before we started manufacturing these products, they represented hundreds of crores of imports into India. We've essentially stopped all imports into India in these products as of today, to the extent that now we are exporting these products globally as well as into China. And so that, I think, speaks to the cost competitiveness that we enjoy and that we have engineered in these products by innovation across the entire process chain of these molecules in terms of chemistry, technology, engineering, and automation. And to the point at which in some of these products today, we define what the cost competitive pricing is globally. That's the first part of your question. And the second part of the question being the utilization. Currently, we have about 6,000 metric ton capacity, and our utilization stands at about 80% utilization.
Very nice. 80% again is a good number here. Mr. Faiz, let's take a deep dive into the three different types of business models you're following, from large manufacturing to contract research, and then also to contract manufacturing. Help us understand how you are falling into them, and also what is the plan across for both the three segments, and how, as a viewers or as investors, how we should look at the potential of these three segments, and broadly margin difference or potential difference between them.
Sure. So we have three business models. One is large scale manufacturing, second is CRAMS, and third is contract manufacturing. The large scale manufacturing is contributing to 70% of our total revenue. The CRAMS is contributing to around 8 to 9% of our total revenue, and contract manufacturing is contributing to around 20-21% of our total revenue. We have developed our own products, and these all fall into the large scale manufacturing. And we have a margins of roughly 27 to 28% in this business model. And CRAMS are the new molecules of the innovator companies with whom we get into contracts or long-term contracts to develop their products. And in this CRAMS products, we have around more than 70%, 70 to 70%, more than 70% EBITDA margins. And in the contract manufacturing, again, we have EBITDA margins ranging from 28 to 29%, and overall average, it's around 29%. And we would like to, yeah, sorry.
Go ahead, please.
So currently 70% is large scale manufacturing, and the two other are contributing to 30% of our total revenues. The mix we would like to have in future would be mostly 50-50. Let's see how the things fall out. Yeah, Dr. Aman.
So yeah, when you start a company, the likes of the innovators across the globe don't come to you and they let you build your assets and infrastructure, and then they come and discuss projects with you. And so that was the historical 5 years ago. That was the historical business model, was the large scale manufacturing business model. And then over the years, as we have established our core competencies and assets and infrastructure that we have, and proven our ability to successfully execute complex molecules for the first time in India, these innovators have started engaging with us now for the last 4 to 5 years, and we've been working on this research and project content manufacturing activities with them, and we anticipate this to quickly grow now, especially in a post-pandemic world as the world opens up now.
Absolutely. So that explains actually your journey here. Now let's also understand your plans. Let me go first to Mr. Faiz on this. On the greenfield plans, as you understand, you're raising funds from this IPO. A part of it is going to be used for setting up greenfield capacity. Your blended utilization at 80% also tells us that yes, 50% revenue growth now actually is going to need capacity. So Mr. Faiz, please help us understand in terms of greenfield plans, when the full commissioning would happen, and how much capacity you are going to build up.
Yeah, so this new project is coming up, the greenfield project plant 3, that is total cost, capex cost is around 190 crores, and we are going to use 163 crores from this IPO proceeds. The project is already underway, and we already spent around 25 crore rupees on that. The project will be ready by November or December of this year, 22, and it would be ready commissioned from that from December itself. So we'll have four months to go in this current financial year. And the capacity that will be adding up will be around 3,500 to 4,000 metric tons in this new facility.
And if I heard that number right, that should be roughly 50% capacity addition, incremental addition.
Yeah, almost for 60%.
Right.
80%, almost 80%.
Okay, so incremental capacity addition is happening around 80%.
Yes.
And when do you expect the sort of optimal running of the plant to happen?
No, we are not allowed to give forward-looking statements, so I would refrain from this.
Sure. Let's
typically in a time frame of a commissioning of a manufacturing plant, depending on the validations that you've already achieved, it takes anywhere between 3 months to 1 year.
Oh, sure. So that's helpful. Now, Dr. Aman, let's go to the R&D pipeline and try and understand where actually you are heading towards in the terms of new product launches. How's the company looking at? Now, suppose if we have 25 products right now, out of 25, 5 and 7 actually have secured good market share. So in which sectors you actually are looking to really launch more products, take more market share? Please enlighten us.
Yeah, so we have a packed R&D pipeline. R&D is a huge focus of the company. We are launching 5 new molecules in this year in the upcoming greenfield production site that Faiz talked to you about, and these are already mentioned in the RHP. And these will all be also made for the first time in India and have been developed by us for the first time in India. And so R&D remains a huge focus. We have 2 baskets in the R&D. One is the large-scale manufacturing products, which we select ourselves and introduce into R&D. And the other is the contract research basket model, where we have client-generated projects. And there's numerous projects going on in both baskets currently. In terms of the R&D spend, 5.4% of our annual revenues are R&D spend, and that's a significant figure. And we are aggressively expanding our R&D. And so as of 2 weeks ago, all the growth that we have seen in the last 5 years has been from our R&D infrastructure X. As of 2 weeks ago, we have doubled that R&D infrastructure to 2x already, and that is fully commissioned. And in about a couple of months' time, we are going to triple that R&D infrastructure. And so a huge push towards expansion in the R&D infrastructure, because we anticipate we have a significant number of molecules from our own pipeline of large-scale manufacturing business model that are being introduced. And we anticipate a tremendous influx of client projects for the CRAMS and the content research and content manufacturing business model in the post-pandemic world. Since we have already established a firm foothold as a trusted and reliable research partner at the topmost MNC innovator multinational companies across the industry spectrum of pharma, agrochemicals, material sciences, oil and gas, and additives.
Okay, that sounds really exciting. Let me take your 2 cents on your existing products, and let me ask you on the agrochemicals here. We have seen MMBC, again, bifenthrin alcohol, GVL, all actually have really done well for you. Based on these products, how much scope do you see right now for taking market share? So I'm just trying to understand the revenue growth here. Your revenue growth has been stellar, vertical. One is taking market share, and second is the sector itself is growing. It's a huge sector, and the demand is actually almost very strong. So how do you see that?
Yeah, thanks, Piyush, for the kind words. But yes, the MMBC and BFA, if you look at the RHP that is shown, we are contributing only about 14% of the overall market share for MMBC. And that is a contract manufacturing, exclusive manufacturing business with a top agrochemical innovator in the world. Bifenthrin alcohol, if you look at the RHP, it mentions negligible contribution in the overall market share. And bifenthrin alcohol, as per easily verified import data, that's an import of 2,400 metric tons into India. And so, and globally as well, there's a significant demand. And so there's a tremendous headroom for growth possible in these molecules. We are the only ones in India making these molecules. And so there is significant headroom for growth, although the projections that have been shown in the RHP and in our data does not include the headroom of the existing molecules. It only includes the projections derived from the new product launches that are happening in this year in the upcoming greenfield production site. And so there's kind of a buffer area for us to kind of sustain the growth that we have seen over the last few years for the next coming years.
Mr. Faiz, one question around the seasonal risk management, environmental cost. We know from time to time, a lot of chemical companies have seen either basically implementation of environmental cost related activity or they had to upgrade. Some they are already following Euro norms. Where are we right now from the environmental implementation perspective?
So we are very much ahead of Indian norms, and we are following the European norms. We are almost 5 to 7 years ahead of Indian norms, and we have in-house our ETP department, Environment Treatment Department, which is taking care of all the discharges which are being taken, which are coming out from the production. And so we do not. We are also started our ESG implementation, which is going on, and we should be very soon ESG certified company. We are also part of UN Global Compact, and we have recently received EcoVadis Silver Line medal, which is only given to 25 total of 25% companies in the world.
We have recently invested into 16 megawatts of solar power in Gujarat, which will be live by the next 2 months, which will take care of the 50% of the electrical load of our existing sites.
Absolutely. So I think you're moving ahead of time. So that I think should be a music for the investors. Yeah. One question I think which we should ask, perhaps the last question which we are trying to understand from you, and that would be from a business point of view, as we are right now, and as we move ahead from a product point of view, is the company also, or will the company also look at inorganic opportunities, or organic is a way to go for you?
So organic is definitely the way. We have 2 greenfield production sites coming up, and we have purchased the land bank, which is 126,000 square meters for the greenfield production site, which is 13 times the land bank that we have today. And so we continue rapidly and aggressively as fast as possible to put steel on the ground and commission the steel into manufacturing plants. But you might have also seen that we have an unprecedented global technology and business development team, and the 3 gentlemen that we have in the US and Europe, who are true techno-commercial leaders who have spent more than 30 years at the topmost techno-commercial levels of multinationals like the Dow Chemical Company, Altana, and Corteva Agriscience. And so with these 3 gentlemen, most certainly inorganic growth and strategic acquisitions in the US and Europe is certainly a target in the coming years. And so when and how we do this remains to be seen, but that is certainly a target. And that is also actually already mentioned in our strategy section in the RHP. And so yes, organic will remain the way to go in the near future, but in the medium term future, we are definitely looking at strategic acquisitions in Europe and USA.
Well, Dr. Aman and Mr. Faiz, it has been a pleasure talking to you. It appears, I think our viewers would have really observed, it's a specialty chemical company, very strong sort of processes which we are building, and a lot of products perhaps which the viewers are going to look with great excitement. We wish you all the well for your IPO, and that brings us to the end of this show. Thank you for watching.
Thank you so much.
Thank you, Piyush. Our pleasure to be here.
Bye.
Thank you very much.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICIdirect.